Executive Summary and Investment Thesis Core Business Overview. Vestis is a provider of uniforms and workplace supplies, uniform rental, lessening, safety/workplace services. Operating across the U.S. and Canada, customers include large corporations, franchises, and smaller businesses. Their product and service scope includes uniform rental, workplace supplies, floor mats, towels, linens, managed restroom services, specialty garments, first aid and safety products, etc. Investment recommendation, 12-month view, hold bull case. Vestis has scale in a relatively stable B2B services market that is less volatile than pure retail. They generated positive free cash flow in recent quarters, and operating leverage may improve with cost discipline. Large TAM, total addressable market, in uniform and workplace supply industry, which is fragmented, gives room for growth and consolidation. Loan debt servicing cost is decreasing somewhat, which eases a pressure point. Bear case. Revenue trends are weak. Recent YoY declines, pressure in certain revenue streams, for example, rental decreases, thin profit margins, and net income losses in some quarters. Heavy leverage, sizable debt load, which increases risk in rising interest rate environments or economic slowdowns, dependence on operational execution and cost control. Any missteps could lead to losses or liquidity stress. Business overview. Operations in key products, services, uniform rental, and cleaning services. Supply of workplace safety, first aid, and related products. Managed facilities, restroom supplies, mats, specialty garments, etc. They rent, clean, supply, maintain. Business segments and geography. Operates across U.S. and Canada. Single main operating business segment as per GAAP disclosures. Primary markets. Customers span multiple industries, including hospitality, manufacturing, food processing, retail, automotive, healthcare, pharmaceuticals, etc. Both large and small customers. Industry and competitive positioning. Industry landscape. The uniform and workplace supplies rental services sector is relatively stable, driven by regulatory standards, safety, hygiene, companies' branding, image needs, and ongoing needs. For example, linens, mats, uniforms, highly fragmented, many regional and local providers, few dominant national players. Growth drivers, increasing regulation for hygiene, safety, cleanliness, outsourcing of uniform facility services by cost-sensitive businesses, potential pricing power with contracts, especially long-term ones, possible tailwinds from ESG and regulatory push for clean, safe work environments, headwinds, rising input costs, fuel, cleaning chemicals, labor, external contraction or loss. Some large national account losses have been reported. Foreign exchange macro pressures. Competitive pressure from larger players with better scale. Competitive moat/peers. Peers include Cintas Corporation, CTAs, Aramark Armed, UniFirst UNF, and many regional uniform. Rental firms. Vestis has scale, but less margin cushion than top-tier peers. Their moat is moderate. Some contracts are sticky, but customers may switch if price or service degrades. Financial analysis. Recent financials as of the third quarter of fiscal 2025 and trailing 12-month data where available. Metrics latest period Q3 FY 2025 or TTM YoY trend comments. Revenue $673.8 million in Q3 FY 2025 TTM. Revenue $2.71 billion, down approximately 3.5% YoY in Q3. TTM revenue down approximately 4.6% YoY. Revenue peaked recently then declined. Operating income Q3 $25 million declined versus prior year $37.5 million. Operating margin compressed. Net income loss $0.7 million Q3 FY 2025. Loss versus prior year positive net income $5 million. EBITDA. Adjusted EBITDA, Q3 adjusted EBITDA $64 million down from Q3 FY 2002 for adjusted EBITDA, $87 million. Margin pressure, margins gross, operating net, Gross margin declining. Operating margin approximately 3.7 to 4%. Net margin tilde to 0.1% in Q3. Free cash flow and cash flow from ops Q3. Operating cash flow tilde $23 million. Free cash flow $8 million. TTM FCF positive but reduced. Balance sheet. Financial health metrics. Debt to equity / leverage. Total debt $1.30 to $1.4 billion versus very limited cash on hand $24 million. Net leverage ratio approximately 4.5 as of Q3 FY 2025. Liquidity. Available liquidity tilde $290 million includes revolving credit facility plus cash. Cash is thin. Efficiency. Inventory turnover moderate. Asset turnover approximately 0.9. Return on equity negative tilde to 3.4%. Return on invested capital modest approximately 2.4%. Valuation. Okay, metric Vestis' latest TTM. Peer industry benchmarks. Commentary PE trailing. Negative due to net loss. Peers like Cintas. Aromark often 15 to 22. Negative PE reflects weak profitability. Hard to value via earnings until profits stabilize. PE forward? Unclear. Volatile given recent losses. You're somewhat more favorable when profitable. Market likely discounts Vestis heavily due to margin risk. EBITDA elevata given EBITDA contraction. Peers approximately 10 to 15. Vestis needs to stabilize EBITDA to justify multiple expansion. PS price to sales approximately 0.2 OTTM. Peers 0.5 to 1. Very low PS shows market's low expectations and risk pricing. Dividend yield none. Some peers do pay modest dividends, not a dividend play currently. Risk assessment. Key risks. Revenue decline / customer loss. Continued customer attrition, as seen with recent national account losses. Margin compression. Costs rising faster than ability to pass through. Leverage / debt servicing. High net debt and significant interest expense. Liquidity risk. Low cash balances. Reliant on revolver. And positive free cash flow. Competition. Larger players with scale advantages. Operational risk. Supply chain, logistics, and service quality execution critical. Upcoming catalysts. Q4 FY 2025 earnings release and guidance. Implementation of cost reduction initiatives, retention, or loss of major national accounts. Potential M&A, either acquiring smaller providers or as a takeover target. Conclusion recommendation. Hold top supporting points. Large and recurring addressable market with essential services. Stable business model with potential for free cash flow. Diversified customer base across industries and geographies. Crucial risks to monitor: sustained revenue declines and margin pressures. High leverage and low liquidity. Execution risk from management. Note: this analysis is based on data available through mid-2025 and is not real-time. Stock prices, multiples, and financial performance may have changed. Always confirm with the latest SEC filings, earnings reports, reliable financial data providers before making investment decisions.